is cracking in trade today is a Dixon Technologies. It's very interesting, Harsh, to see a Dixon Technologies because the earnings optically don't look bad at all.
Yeah.
Brokerages also have been positive in terms of their coverage, and on a consensus basis, you've seen a target price upgrade that has happened to a certain extent, right? So it's interesting and a really difficult task for a researcher to understand what's actually going on. In fact, Puneet has done the crunching in terms of what actually went wrong with the Dixon Technologies. Puneet, over to you. A 14% cut right now.
Well, that's right. You know, it's seen under pressure, but as you rightly said, Q3 earnings were a beat across all fronts. Revenues grew 117%, profits were up almost 120%, and they maintained their margins of about 3.8%. That was a positive. But let's look at the bull as well as the bear case of what might have, cracked the stock in trade today. They have, of course, they are looking to enter into the semiconductor foray of components specifically into display fabrication that will expand the market for the component side. It's important to know that the company had previously mentioned and guided they will only look at the non-semiconductor components for electronics that they manufacture. Now, of course, they are entering the semiconductor foray as well, and this will be very capital intensive, and that's why the Capex for their share only will be roughly 7,000 to 8,000 crores. Overall, the company has guided that this new foray will require 25,000 crores in Capex over the next 3 to 6 years, of course. And out of that, roughly, a lot of it is subsidized. So let's look at the second key aspect of the bull and bear case as well, that while, they are going to set up a joint venture for display fabrication, which will take half of the Capex from the company's side, it's still expected to be roughly 5 times its annual Capex. Currently, for FY25, they've guided between 600 to 800 crores. Assuming that, the display partner has a 50-50 share in a joint venture with someone like a Dixon Tech, it will still have to, commit roughly 4,000 to 5,000 crores of Capex just for this one venture. It's 5 times its annual Capex currently, and that will, put a strain on its financials as well as its working capital as well. The other aspect is the pressure on its return on capital employed. It's roughly over 40% now, and the new unit will have lower return on capital employed as well. Currently, when you look at the third bull and bear cases, of course, the mobile segment has been, growing over 150 to 200% in each of the last 3 quarters. This quarter also was roughly 190%. But the other segments such as consumer electronics as well as the home appliances segment has been affected majorly. Consumer electronics down 32%. While on an overall revenue basis, it's only 6 to 7%, but on a margin basis, it's above, roughly about 25%. So that has been, affected due to weak demand. And finally, on valuations, like while the new foray of the company will give company double-digit margins, much higher than the 4% that they do currently, it is, of course, going to be very capital intensive. On the bear side, while, it might not be a direct correlation, the valuations is something that's another thing to watch out for. After the correction, is somewhere trading around 78 times price to earnings for FY26. They are expected to double their revenues in about 3 to 4 years. So the price to earnings goes down by half in that aspect. But the new foray is something which has brought more questions than answers, does expand the addressable market, but pressures on the capital, on return ratios, as well as Capex will be something to watch out for going forward as well.
Thank